Good morning, everybody. I'm delighted to welcome you to our sort of third of four manager showcases this week. Yesterday we focused on AIM IHT, where your pension money can nestle in the extraordinary area of credit, debt, and green energy financing. And tomorrow we're talking about EIS. But today it's all about SEIS, early stage growth, effectively where innovation meets funding. And I'm delighted to welcome 5 managers that we all work with on the platform, the CoInvestor platform, where you can invest without any platform fees, and build up a diversified portfolio across these managers. So and I think we will touch upon diversification today as one of the top. I know we were chatting before we started about that, so quite interested to follow up on that. Bit of housekeeping. This is scheduled to last 1 hour. There is a Q&A and also a chat function as well, so please feel free to use both. If you'd like to share your thoughts, or then please use the chat function. Each of the managers will be speaking for 8 minutes, and I do have a very latest technology as a timer, and everyone's promised to keep to that. But today's really about the managers. So I'm delighted to welcome Damon Bonser from British Design Fund, Jeffrey Fostin from Jensen Funding Partners, Andy Davidson from Nova Growth, Keelan Doyle from Simvan Capital, Matthew Cushion from Worth Capital. And what we'll do is we'll kick off with Damon from BDF, the British Design Fund. So over to you, Damon.
Thanks, Chris. Morning, everyone. So I'm Damon Bonser, founder and CEO of the British Design Fund. What we do here that's a bit different, I guess, is we invest in and support British-based product design and manufacturing businesses. As the slide sort of says there, it's kind of shocking that the UK has such a huge design sector. When we produce some of the world's best inventors, some of the world's best product designers, but we often lose them either overseas or they get snapped up by other companies, and the talent doesn't stay here. And we as founders of the fund, we sort of noticed this really sort of 3-4 years ago when the concept of the fund came together. And we just saw that there was a part of this economy, the really early stage, often pre-revenue, or they might have just started turning over. But these startups, if they were product design, design led and had a manufacturing element to them, so there was hardware within their offering, they were really getting looked over by investors. They were struggling to raise the money they needed to take their products through to market, and really importantly, they were struggling to get any commercial sort of insights and expertise and support. So that's kind of where we come from. We started the fund. We're all kind of we're product entrepreneurs. We're leading thinkers and experts within the creative and design space, prolific investors. But I suppose importantly, we've not come at this from a kind of, I guess, a private equity background. We've come at this as really sitting often on the other side of the table and understanding the challenges that these companies face. And so we've kind of come together, and we offer obviously the investment, and we have an SEIS and EIS funds, and to the companies that's obviously very important, but probably more important to them is the expertise they get access to. So they get not only us, the team at the fund, and I'll run through, if hopefully got enough time to run through the team quickly later on, but they get access to us. So every business gets a lead mentor, which is one of the directors of the fund. They also get access to our pool of expert mentors who are pulled in every month to provide really specific, tailored support around digital marketing or setting up manufacturing tooling, those kind of things. And then they also get access to, they also get assigned a mentor from a prior cohort. So all of the sort of the training, the coaching, the expertise that goes into each business then gets passed on. So we create a bit of an ecosystem for those companies. So I've kind of covered why we set up, and I suppose really the takeaways in terms of what makes us very different. first and foremost is the fact that these businesses have to be manufacturing something. That's our biggest point of difference. There's a lot of really good support out there for sort of maybe software only businesses or kind of more generalist sort of approaches, but really what sets us apart is, to the exclusion of everything else, we will only support businesses if they have a hardware element. So that's kind of number one. And it's worth mentioning, we don't, a lot of our businesses are still heavy tech businesses, but they just may have struggled raising the finance or struggling coming over some of the manufacturing challenges, because they have maybe 20% of the business is hardware. And then there's obviously other ones which are almost 100% hardware businesses. So that's one. And I'd say the other point that sets us apart is the support that we give them. We very proudly call ourselves an operator-led fund. We really do roll up the sleeves. And to give you an idea, the kind of support typically that we'll give a company, it's internationalizing very often. So, helping them set up partnerships overseas, licensing or distribution. It's helping them set up and scale up their manufacturing. It's really a lot of the go-to-market, so setting up marketing, sales strategies, but helping them execute those. And of course, it wouldn't make sense if we didn't open up our black book as well. And so we can often get them their first significant kind of accounts, whether that's distributors in various territories or getting them access to institutions in the UK, possibly, to get their first orders through. And what we look for in companies is worth covering off. So aside from the obvious that they have to be manufacturing something, there should be some IP there, or there has to be some IP there. We like patents, that's good. We can also accept, design registrations are fine as well, and sometimes the most appropriate form of protection. I suppose that is very, very important to us. Also important is the fact that there should be some form of validation of demand. So that can come in the form, they may still be pre-revenue. So that might be pre-orders. They may have done a very successful Kickstarter campaign, for instance. That's fine. That is validation of some sort. They may have had institutional buyers possibly approach them. Very typically at a trade show, for instance, they might have had overseas distributors approach them and have letters of intent or purchase orders. So that has to be there somewhere. It can't just be sort of all kind of speculative demand there. And we will check all that on our due diligence as we go through. Also, very importantly, we are the design fund, and what that means for us, probably, it means a number of things. We understand the importance of good design, but that's still quite vague for a lot of people. I mean, I think that the easiest way to communicate how, I suppose, design filters through to our selection process is that the founders have to have taken a user design approach to starting their businesses. So we don't want nice to haves as such. We like founders that live and breathe the market. They intimately know their market. We shouldn't need to train them up on what their users need or how they behave or how they should be sold to. We'll provide the frameworks and professionalize this, but they really need to understand that market, and there has to be a compelling need or very clear problem that they're solving. That's very, very important for us. And then a lot of the other things will be very similar to what other funds in other categories and sectors look for. Winning team and our we look for ROI to investors within the 5 to 6 year period. So all of those things play in, and that filters through to the kind of valuations we see. And I suppose on that point, it's worth mentioning the valuations are typically. If we're putting in 100, 150k, it's typically around sort of 17, 18%. It averages out. If they're sort of pre-revenue, typically, or if they're just starting. But we do sometimes take a smaller position if we really think they've done something very clever and they may have received some funding ahead of us joining the round. And then other things to cover off. So the team. So we started it a few years ago. We're on to our third fund now, but it was founded really with a bunch of minds coming together at the Design Council. So it's myself, my background's, I've had my own manufacturing businesses. So I guess I'm the kind of startup manufacturing expert. We have David Kremer, who most famously owns Rubik's Cube, so knows manufacturing on huge scales. We also have Luke Johnson, prolific investor, sort of in the UK, is pretty well known, and John Mathers, former CEO of Design Council. We've got, there's sort of 7 or 8 of us there that form the committee and the directors, but we all come at this from a active investor space. We all invest our own money in each fund, and but also importantly from a product and creative space. So we bring a real mixture of that expertise around manufacturing and product, expertise around how to market and sell product businesses, and also kind of the legal expertise. And Chris, I can see you sort of waving at me. I feel like I might be approaching the 8-minute mark here. How am I doing?
Yeah, you're about there, David.
Perfect. I think I've covered. Oh, yeah. I won't have time to give you any examples of the companies, but videos and portfolios are available up on our site and on CoInvestor.
And just before we hand over to Jeffrey, David, what's the minimum size investment into?
10,000.
10,000. Okay, brilliant. Thank you. Okay, thank you, Damon. So we'll hand over to Jeffrey at Jensen Funding Partners. So the floor is yours, Jeffrey.
Thanks, Chris, and hi, everyone. Yes, I'm Jeffrey Boston. I'm one of the partners at Jensen Funding Partners. Jensen is probably one of the longer running SES funds. We got started back in 2012 when SES started, and actually SES was the reason we got started. Our founders, Paul and Sarah, they ran a sister company, which is a part-time FD company, and when SES came about, it kind of made sense to try and create a fund off the back of that. We got support from some established VCs, and we kind of got off and running. Since then, we've been, working really hard. We have done 108 SES investments to date, and we have been pretty successful with the earlier tranches. We've been consistently investing across the years, and we've done 8 exits to date. That kind of averages out a return of about 3.5 times if you consider cash plus shares. A point here to note is that most of our exits have been cash exits, more than 6, and we are expecting another one before Christmas, and hopefully a couple more before the end of the year. So our earlier funds are now starting to return for us, and we're quite focused on getting that done. As with every fund, on the flip side, we have failures. Our failure rate, we expect, or we model a failure rate of 60% to get our 1.85 return to our investors, and we're currently at about 30%, so we're kind of sitting well within that. So, again, we work hard on that as well. Another thing to note is that, a large part of what we do is we try to, support the companies, and in order to do that, we try to find companies that we can work with. So when we look at the criteria, obviously we look for companies that are innovative. They have, great USP. They've got great defensible IP. But more than that or above that, we look for companies that have a management team that we can work with. Is really, really important for us. Being able to talk to team and have them respond to our suggestions is really key for us to be able to work with them and get that return for our investors. So it's kind of one of the key things we look for. We have a dedicated kind of portfolio management team that supports the companies, and another part of the support that we provide to our portfolio is we give them access to our ES fund. To date we've done 18 or 19, I think 18 syndicated ES investments, and a large part of that is the fact that we're able to draw upon our larger network and get that syndicated. So on average, we do about £3 for every pound we put in. They have access to about £3 of funding. In terms of the fund and what we look for, we are very much sector agnostic. We have a diversified approach. We have now reduced it to where we do about 8 to 12 companies a year. We used to do more than that, but we think 8 to 12 is a much more manageable number, and that seems to work really well for us. In terms of our deal flow, when we started originally, we had our sister company, the funding, the finance teams, reach out and help us with that. But over the years, over the last kind of 7-8 years, we've really established a network of opportunities. we've got incubators and accelerators and other introducers that we have deals from, and we probably invest in about 2 or 2.5% of what we see. So we have a really structured approach to kind of going through opportunities. We see quite a lot. That's a really good source for us. And one crazy thing is that we've actually invested in companies that have been introduced to us by companies we've kind of rejected. So I think we're doing something right for a company we've turned away to still kind of recommend us. I said before, we have a tailored support program. It's really a key focus for us. When speaking about this particular fund, we are open. We're open for investments, and we're looking for opportunities. We already have 4 of our opportunities for this fund already agreed and term sheets signed up. So we are hoping that we are able to deploy very soon after we closing the fund. So we would expect to get that done before the end of the tax year as well. We have kind of a fee structure is pretty typical of an SEIS fund. We don't charge any upfront fees to investors. We charge fees to invested companies, and we are always looking at ways to kind of make that more competitive. We do have performance fees to the investors, but that's only if we return over a hurdle, and also return over a hurdle across the entire fund. So we don't actually pay back any cash to our investors until they get their full pound plus hurdle rate back. I'm happy to talk or answer any other questions you have, but that's pretty much a snapshot of Jensen and our fund.
Thank you, Jeffrey. Just a couple of questions that were coming through as you were speaking. What is the size of, and this goes to everybody if you can cover this off, the minimum investment and what is the size of your fund as well?
Our minimum investment is £10,000, and then it goes up in multiples of £1,000. The size of the fund, again, because we're doing between 8 and 12, we do 1.5 million per tranche. We sometimes close 2 tranches in a year, but the way we do it is as soon as we have sufficient to deploy into 10 companies, we'll close that. And it's just an evergreen fund, so we close that and open it again. So in order to close, it's about a million to close. But then we open it as a new fund straight after that. So technically it's evergreen. If that answers your question.
Yeah, sure. And I think you covered it off. The hurdle rate. What's the hurdle rate and percentage fee?
Ooh, I'm gonna get this wrong. I think it's 1.2 is our hurdle, and I think it's 20%. I'll have to clarify that. I should know that. Sorry.
And it's worth mentioning to all of the audience actually. CoInvestor is, I think, this week launching in association in conjunction with the EIS Association a sort of transparency calculator on our platform. So you'll be able to match everybody's funds and what the fees are. So that should be going live, I think, this week on the platform as well. So okay, thank you, Jeffrey.
No problem. Thanks.
Appreciate your time. So next up, it's a very cozy looking Andy Davidson over at Nova Growth Capital. So I'm glad you're still with us and haven't had a nap, Andy. You're very relaxed. So, but I'll hand over to you, Andy. But you are on mute just before you kick off. So.
Well, I'm glad you pointed out I was on mute. Otherwise, I'd have been talking to myself for the next 5 minutes. Yeah. So I'm Andy Davidson. I'm the chief exec of a business called Nova, and we are a venture builder. We do run an SEIS and EIS fund via Nova Growth Capital. But predominantly Nova's in the business of building startups. So we identify talented founders and we co-found companies with them. Our investment fund invests alongside us. We do this at scale. So last year we co-founded 23 companies. We have a venture readiness program that kind of provides us with deal flow pipeline of appropriate founders. We get about 40 applicants a week into this, and that kind of runs continuously. When I say co-found companies with founders, predominantly that's all around us, surrounding them, all about us, surrounding them with teams. So if you look at our business, we look at kind of like a hybrid between a accelerator program, a technology company, and an investment fund. And the technology company aspect, we employ about 100 individuals within that are the types of people that you would find in a tech startup. Predominantly software, but we do some hardware in the kind of sensor space. And actually, I really could do with picking up with Damon about that after this call. Those individuals are kind of hardware engineers, software engineers, product managers, digital marketeers, lean startup practitioners, everything that we need to build a team around the founder and create a viable product and, more importantly, a viable business model. We've been doing this since 2008, and obviously we've been through a number of iterations. In that time, we've co-founded over 100 companies. We've had 4 exit events so far, and the ROI on them has ranged from, I think our lowest one was 4x, our highest one is 40-something x, and that does kind of lend itself to the whole portfolio diversification story, because I think when you invest in SEIS, you should expect the winners to win really, really big. We focus, we're sector agnostic, but we believe we're experts in early. So we talk about being experts at 0 to 1. So it's from taking the concept for a business and turning it into a business that has user traction and revenue. We've identified through probably our own personal experience. I mean, we've done 100 startups, but actually within our team, we've probably got experience of over 1,000 product development projects, either for startups or for big companies. So kind of from our own anecdotal experience and from doing research in the market, we found there's a number of core reasons why startups tend to fail in the first couple of years. And actually 90% of startups tend to fail within the first 3 years. And our hypothesis is, if we establish the reasons why most of these companies fail, and then we have a strategy for mitigating them, then our target returns will tend towards the markets. And that hypothesis has been borne out, and we've got really good data that's obviously available to third-party researchers and via our due diligence pack. And compared to the market, if you look at the market, there's some data published by Bowhurst that I tend to refer to that kind of shows that if you had a very large portfolio of SEIS and EIS businesses in the UK tech market, I'm going to say very large, I mean 500 or 600, you'd have seen a 34% year-on-year growth in the value of your investments, and that's setting aside the tax benefits. We've managed to reduce the failure rate in our portfolio down to about 50%. And our portfolio rate of return is well above the market norm of 34. I think our latest set of figures show that over 10 years we've delivered 84% year on year. So what we're doing definitely works, and we can evidence that. We've typically in the past either co-invested with other investment funds, or we've run our own managed angel syndicate. We've got some luminary investors in that syndicate. Probably the highest profile one is Sir Terry Leahy, who I guess needs no introduction. In 2019, we launched our own SEIS and EIS fund, and that was more to, I guess, better manage our existing angel syndicate, and also to introduce some further capital. Due to our operating model, there's only a certain amount of capital we can raise and deploy each year. We've been continuously scaling our business, and we know that we can scale at 50% year on year. So unlike probably other funds, we've got a clear idea of how much we can raise and deploy without breaking our business model. And at the moment, we are looking for partners, so financial advisors, wealth managers, intermediaries that are willing to take the time to understand our business model, understand why it works, critically understand the benefits, the massive benefits SEIS and EIS can bring to a portfolio, but only if it's sufficiently diversified. And when I mean that, I mean invest in everyone's product on this call. You need to build a portfolio of at least 100 underlying assets in order to ensure that you deliver a positive return. So we want to find people who are interested in our model and interested in why that works, and can provide a supply of capital to meet our requirements. And I suspect once we've identified that group of partners, we'll take our product off market again, maybe in 2021, 2022. And that's Nova.
Okay, thank you. And could you sort of cover off the questions that have come in, with regards to the site minimum investment and the size of the fund and your fees, please?
I think it is £5,000 minimum investment or £500 a month, and we're keen for people to invest monthly because we deploy at multiple points during the year, and it makes it easier for us to get people into more and more deals. And obviously, our plan really is, we want people to invest in multiple years because then we can cover them on our whole portfolio. Because what we don't want is for anyone to miss, any of the the real outright winners. In terms of fees, we don't charge the investor any fees. I think we pay, or we allow the advisor to charge the investor 3%, but if it transacts on our platform, we'll pay that for the investor on the investor's behalf. When we invest into a business, we charge a 5% investment fee, and then we charge them a 2% management fee. So obviously that's on the business, not on the investor. We have a performance, the standard kind of 20 and 20 performance carry instrument. So after we've returned 120% of the investor's investment, we then charge a 20% performance fee. So pretty standard stuff, really. And I'm really pleased to hear that that CoInvestor are putting a transparent fee structure in place. We've seen a lot of deals over the years, and I think some of the fees charged to startups are nothing short of rapacious, and they are hidden in interestingly worded clauses in people's IMs. And I think that the quicker we can get away from that kind of nonsense, the better for the industry.
Well, thank you, Andy. And yeah, it's been quite the job getting the transparency calculator together, but we've been delighted to be working with so many fund managers on it, actually. So there's a lot of support in the industry for this transparency. So thank you, Andy. So next up, it's Keelan over at Sinvin Capital. So Keelan, the virtual floor is all yours, sir.
Thank you, Chris. Interesting that fees have been discussed. I was on a similar call yesterday, and Mark Bramridge, the Director General of the EIS Association, was one of the participants, and we got into this because they, as we all know, that there's been a best practice initiative launched by the EIS Association, and that was the focus. And we were discussing this yesterday because Evar Karelzy, who's the head of product at Tilney, was also on the call, and we were on a panel talking about this. And in particular, and I think this is Andy just mentioned this, the real I remember when we first started in this industry, and having been in other asset management industries, fees were always very transparent, and I think this industry is getting a lot better. But it was it used to be where they charged the investors. And that was usually outlined in the IM, because for FCA reasons it would have to be. But everyone called fees different things, and it was very hard for investors to compare. But of course, the real the devil in the detail, as it were, is that there would be something vague in the IM talking about how much companies charge the investee company, how much fund managers charge the investee companies, and that of course was well, let's just say left very vague. So we've been banging this drum for a number of years at various industry events, and we've actually announced an initiative where we are, and this is more for our EIS and our SEIS, but where we're announcing or going to make available certainly to panels and analysts, etc., exactly what we charge each company. Because sometimes, and Andy hit the nail on the head, you wouldn't believe how much people charge. Now, having said that, the industry, if you're doing the proper job, is expensive. It's not like normal asset management where you're dealing with a listed product. So our fees, for instance, for SEIS, we primarily market EIS, but we see SEIS as part of the continuum. Our fees are pretty expensive, I think, but they're totally transparent. So they're 10% we charge to get into our SEIS, and they're 2% ongoing, and that's only charged to the investee companies. We don't charge the investor anything except for carry. But what is the idea behind our SEIS? So our SEIS we look at as we don't really actively market our SEIS because we don't want to raise too much money in SEIS. We look to invest in about 4 or 5 companies a year, and we look at it as an incubator accelerator for our EIS. And we spend a lot of time even, I mean, I have seen in the market over the years, some people take a different approach, and it probably works equally well, where they raise a lot of money and invest in 30 companies or 40 companies a year. And we're really looking at this more. I mean, when we first came into the industry, I would be on the presentations to a lot of people who aren't in the market anymore, or aren't as prominent in the market anymore, such as Downing and Octopus and who else? Oxford Capital. And they'd all be talking about a return of, give me £1, I'll get you £1.10 back. This is pre-patient capital review days, and we'd be talking about achieving returns that $2.85 per £1 invested, and we've stuck to that that mantra, and we're well on the way to achieving those returns. But we have something we call our life cycle approach. And what that basically is that again, when we first started, we looked at SEIS, and for a brief while, SEIS was actually a total no-brainer because if you had capital gains, you could get all of your money back if it went bust. Now the Treasury figured that out very quickly, and that ended. But still, you get most of your money back, particularly if you have a CGT position, and that's becoming more and more interesting for investors because it's pretty obvious that with the current crisis, the Chancellor is going to be looking to raise money from a lot of sources that perhaps he hadn't considered up to now, and one of those very clearly is capital gains. I think there's going to be some adjustments to pensions as well, but capital gains are almost certainly going to get hit in any number of ways. But probably first, the most obvious and the easy way is to bring them in line with income tax, and that'll make EIS and SEIS even more attractive, particularly versus VCTs. So our life cycle approach is part of our philosophy of, and again, it's very related to our EIS, is when we invest in an SEIS company, we're looking at if they make the grade to invest in them over a period of years and get them to a sort of Series A, Series B level. Our SEIS companies tend to be, I mean, we're a technology investor. Within technology, we're looking at, I mean, there's different pots. There's some people who invest in university spin-outs or consumer tech or life cycle, or shall I say life sciences. We're looking at B2B SaaS models in the main. We look at things like insurtech, fintech in general, blockchain, enterprise VR and AR. That's our sort of raison d'etre. But with respect to graduating from our SEIS or EIS, getting back to when we first started in the industry, we realized that people, because there weren't very many people who were looking at technology investing, it was considered, when you do these presentations, sort of like the Wild West. And SEIS was a very valuable function for us in that it was something that de-risked our EIS proposition. So we'd say, I mean, even people now, then who were growth investors, would talk about £1 turning to £1.40 or £1.60. So £2.85, which is an IRR in the just shy of the mid-20s if it's within 7 years, is pretty modest. And I think baked in there is our assumption of a 50% failure rate. And in 28 or 29 SEIS investments over the past 6 years, we've had 2 failures. So we assume a 50% failure rate, but we don't count on really getting there. Now, 2 will probably turn into 4 within the next year. I can certainly see 2 that just aren't really getting any traction. But even that's a very, sort of a 10%, maybe slightly higher. I think, again, I think Andy mentioned 90% failure rate. That's a usual sort of failure rate. Now, having said that, our SEIS tend to be a little bit more advanced than what we think. It's not just someone with a PowerPoint and an idea. It tends to be someone with some, who's put a fair amount of their own money in and has a decent amount of revenues. But our general thing is looking for very scalable propositions. So the 285 could end up being conservative, but I think if we achieved the 285 per £1 invested, most people would be very happy. We've had 2 exits out of those companies. One was sold to an insurtech company. Actually, we just had the chairman leave that company in the summer. She became CEO of Aviva. I don't know how many of you follow the business pages, but she's been in the press quite, seems to be in there every week, mainly because she's dramatically restructuring Aviva. But if I was to leave one, we've also had 2 failures. Those 2 failures, actually, they both didn't outright fail. One was wound down, but basically returned 1p on the pound to the investor. And the other was a company that just got so diluted because it had so much debt. And that was a really interesting case in the gaming sector that it's very interesting in terms of our philosophy, because our whole idea is that we get involved in the SEIS. So because in private equity, until you're really no matter how much diligence you do, it's really when you're involved in the company when you really know where what's happening with the company. And hence that's, it was a case where they asked us for more EIS investment, or our EIS fund coming in, and we refused because of the debt level, and also the KPIs were in line with what we were expecting. So currently we have 2 SEIS funds open. One is a technology company. A technology fund which has about I think it's about £2 million size, and the other is a gaming and entertainment company fund, should I say, which is just starting just a few hundred thousand.
Thank you.
Minimum subscription on our SEIS is 10,000, and I'm just seeing if I think I've covered all the points there. Chris?
Yeah, I think you have. Yeah, and the Q&A is open, so if anyone has any other questions, please put them in. But thank you, Keelan. So last but hopefully not least, Matthew, we'll hand over to Matthew at Worth Capital. So please take the floor, Matthew. Oh, sorry, just before you do, sorry, that's terrible for me to do that. But just to clarify something Keelan mentioned, I think from Andy, Andy was mentioning the statistic that 90% of startups fail. I don't think Andy was mentioning that 90% of his investments fail. I'm sure that wasn't taken anyway, but I just wanted to clarify that. Sorry, over to you, Matthew.
Hi, everyone. I think what you've heard this morning is that we've all got plenty in common. I want to land 3 things for you today about the Startup Series Fund. And the first is that we are obsessed about insight and markets. My background, my profession, if you like, is a retailer. I used to have an eighth of Woolworths when I was about 28. Homewares, about £250 million P&L accountability. But then I went on for the last 10 years or so of being an innovation consultant. And what I learned is that great innovation is rooted in empathy with markets and real market understanding. And that's what we look for. And I think a good example of that is a company we invested in called Vitru Health, which is a set of smart motion sensors and depth sensors that physiotherapists can have on in the background of testing their patients for musculoskeletal health. And at the end of their 20-minute assessment, out pops a PDF that shows exactly the range of movement within joints and the range of muscular strength, and that replaces a Word document that they would traditionally send to orthopedic surgeons. And that's an example of a gap in the market that is a phenomenally big market, and that was a yawning gap waiting for a solution. The other part of markets is that we need to see them underserved. We need to see room for that innovation to breathe. The second thing that makes us different, I think, is our sleeves rolled up help. So I think you've heard a little bit of that before. My business partner is Paul. He's been an entrepreneur since college. He's built and sold businesses before, and he's an expert in marketing and brand. And that's the other thing that we look for. We look for businesses that can build habitual consumption. It can be consumer or it can be B2B. But on the back of that, you can build a loved brand. And that means that you can build additional exit value over and above just EBITDA. But it also means this is a lot of the help that we give. And an example there would be a business that we invested in earlier on this year, which came to us. It was called TradeSmart. And what it is some really simple tools, app-based for tradespeople like electricians or plumbers or roofers or tilers, to be able to give professional quotes to their clients, but then also to hold cash payments in escrow and or to give interest-free finance, which allows them to compete with much bigger firms. We loved the market insight. One of the founders was an electrician, and he teamed up with a tech developer who'd been in Silicon Valley, and also, believe it or not, an actual real life rocket science, a PhD astrophysicist from Cambridge. And so brilliant team, brilliant bit of insight, but their proposition wasn't that well formed. And the first thing that we did when we invested was to hone that proposition, hone exactly the target audiences, the need states, how they got that proposition across and how they articulated it. And then actually at the end of that out popped a different name and a different brand identity and different kind of tone of voice for that brand. And now they're called Candor, which is a bit more modern, it's a bit more kind of tech orientated, but it also represents the kind of relationship that they're trying to form between tradesperson and client. It also happens to be much more future-proofed because they can take that solution into different markets beyond tradespeople. But other help that we give, we sit on the board of each business. You can see that at Company's House. It's completely upfront and transparent. That gives oversight and transparency to our investors. But we also help with things like strategy. I'm quite a simple person. I think strategies, particularly when it comes to helping entrepreneurs, it's just about helping them to consider different possibilities rather than be too myopic about their thinking, help them to make sure that they are assessing those possibilities properly, and then helping them to make confident choices. We also help with things like financial management, raising future rounds, etc. When that's not follow-on EIS cash from our fund as well. When we look for funds with bigger pockets than ours. But we'll do anything that kind of helps to fill a gap. And so an example here would be a business that we invested in 18 months ago, Bedfolk, which sells really rather remarkably luxurious premium bedding for an amazing price direct from a artisan mill in Portugal. And this is their entry into the consumer textiles market, and they sell it direct to consumers. They, in 18 months, have gone from £6,000 per month revenue when we invested, which was kind of proof of concept of that market need. We also had seen some stuff happening in the States that made us quite interested. And in 18 months, November that's just closed, they did £261,000 in a month. So stratospheric growth. With that came some challenges, and availability was one of them, and inventory management. And we kind of spotted this. I would like to have spotted it about 6 weeks earlier, actually, to be brutally frank, but we spotted it in reasonable time. And one of my previous roles, bizarrely enough, was supply chain at John Lewis. I was looking after the supply chain for department stores, and I brushed off some textbooks and created an inventory forecasting, ordering and planning model for them to give them much more visibility, to give them control over their working capital, and most critically, to give them confidence to place some big bets on stock. And that's come through in the way that they've been able to grow their business. And then the last thing that's unique about us, or a bit different about us, is that we do have a unique source of deal flow. We get our deals through a competition that we run called the Startup Series. It's a monthly competition, so in effect, it's always on. It is promoted on smallbusiness.co.uk and growthbusiness.co.uk, so you can imagine that gets a lot of eyeballs. And we tend to have about 100, 120 entries per month. But the point is not the quantity, it's the fact that these are coming from all over the UK. We're not reliant on the London bubble. We're not reliant on the old boys network. And we see different deal flow, which also means that valuations are artificially inflated by different fund managers competing over the same deals. It also actually leads us to a much more diverse set of founders to invest in. Whereas in our type of cash, only, depending on what you read, between 9 and 16% of cash goes to businesses with female founders. 40% of our cash goes to businesses with female founders. That happens to be good for society, but more importantly, it's a sign of unbiased investment decisions, which is good for returns. And then, you know, incidentally, 19% of our cash goes to businesses with BAME founders, and 70% of our cash goes to businesses outside of London, which kind of flips on its head the industry norms.
Okay.
And then to your points, Chris, about AUM and tranches stuff. So AUM 4.5 million, minimum 10 grand. That can be in, we do 3 tranches per annum, or aim for 3 tranches per annum. That minimum can be in 1 tranche, but we would encourage people to spread that over the course of a year. And over the course of a year, we should do between 8 and 12 SEIS investments.
Okay, thank you. And what's your fees hurdle?
So we're slightly different actually. So we're very similar to everybody else, as you'll see on your transparency calculator on fees. It's it's no fees to investors. The fees are on investment and a little bit per annum to investees. The thing that marks us out slightly different on fees is that we don't charge a carry to investors. We take a option in the business on our first investment. It kind of does a similar thing. We just think it slightly improves the alignment between the entrepreneurs, the investors, and us.
Right, thank you, Matthew. One thing that we've all touched upon is diversification. Something very close to my heart. I spent 25 years before I got the tech bug in asset allocation, and diversification is something I'm a big fan of. One of the reasons CoInvestor exists is obviously so that investors or advisors can build a diversified portfolio across multiple funds and manage it all in one place. But I wonder, just in this world of risk and COVID and all of the other challenges and credit and everything else that the world's facing or is going to be facing. I just wonder how, if each of you could sort of touch upon diversification briefly, and what it means to you and what it means to your fund. And Damon, can we kick off to hear your thoughts on that?
Yeah. So obviously we diversify across from an investment point of view in terms of the product categories. We're sort of we do consumer businesses, we're doing industrial, sort of big engineering businesses, design projects as well. But I think you're sort of possibly hinting at the founders as well. So kind of split between female and ethnicities. I mean, for us, we're, you know, I suppose we're founded by product guys, and a lot of our, you know, I suppose we're not that diverse as a founding team and as my committee. And we're aware of that. It's a lot of kind of old pale males at the moment on our board. But I suppose what I suppose gives us a diversity when we're looking at the companies is that we think kind of like engineers a lot of the time. So we're driven by the fact that we're driven by products being sold or compelling needs, like I mentioned, and that really drives everything. So it means the founders come from completely different, really different backgrounds. So, you know, some of our female founders, you know, footwear businesses that live and breathe the market. But again, for us, when we're making our selection, our decision, it's all driven by how well do you know your market, and I suppose where our deal flow comes from. It's sort of you know, we're so unique that I don't know, I guess like the old boy bit that was mentioned, it doesn't really impact us. But I'd like to say we're kind of blind to it. Like, we're driven mainly by the solution and the product and the hardware, and we genuinely, you know, the founders, as long as they're credible, we don't care kind of what you look like or sound like.
Okay. Thank you. And Jeffrey, diversification, what does that mean? What does that mean in your fund?
Yeah, I think diversification is really key to what we're trying to do and how we try to mitigate the risk to our investors. We tend to diversify across, I guess, wide ranges. You know, we're an agnostic fund first and foremost, so we diversify across sectors. There are very few sectors that we don't get involved in where we don't feel we have enough kind of expertise, so we don't do kind of film and music and that type thing. But we're pretty much sector agnostic. We also diversify across stage of investment. If you think about, you know, we do some pre-revenue, some post-revenue, and we obviously manage valuations to match. If you think about the risk profile of the company, we diversify across that as well in terms of within every portfolio, we might have one or two what we call binary options in there. It's either going to go, you know, really high, it won't work, and we try to mix that across the board. We also diversify across geography. So we've got kind of, we've got 40% of our SEIS companies not being inside London. So, and as we go, you know, we have companies in Scotland, Ireland, Northern Ireland, you know, across the Midlands, and, you know, pretty spread. We have companies in Wales as well. And of course, we diversify across gender. So we've got just under 27% of our portfolio companies have female founders in them. So yeah, it is very, very important to us. It's something that we try to make sure that we include in every portfolio, so that we, you know, and when we look at a portfolio, when we put a portfolio together, we think about this across all these sectors. So yeah, it's of extreme importance to us.
Okay, thanks, Jeffrey. And Andy, what does sector agnostic, or what does diversification mean to you at Nova?
Well, there's two things going on here, and I'll briefly talk about Nova, and that's very much the small thing that's going on. So if someone invests with us, we'll put them across 10 different assets. If they invest a couple of times in a year, we'll likely spread them across 20 underlying assets. We're sector agnostic, so there's good diversification within the types of businesses that we invest in. But let's just set Nova aside, because actually diversification within the manager is probably a bit of a red herring, really. I think if you look at the research that's out there, and actually we're going to release a paper in the next several months that will pull together a lot of this research and talk about diversification. If you look at the market, there's a lot of research there that talks about how poor a job fund managers do. Now, that's an interesting thing for me to talk about on a call when we're all talking to, you know, our potential customers about how good we are. The reality is, if you look at venture capital as an asset class, half of fund managers don't deliver a positive return. 25% of them don't beat a standard 6% year in, year out. And at the 25% that do, I can't remember the exact numbers, but a large amount of them can't repeat this cohort on cohort. So actually, if you look at it, it's not great, really. Now, we do have the added advantages of the tax wrappers that we utilize that give downside protection against, you know, loss relief, etc., and accelerate and enhance returns. But widely, you know, fund managers don't do a great job. What does do a great job is the underlying asset class. Now, what fund managers allow the investor is access to that asset class, because it's otherwise off market to them. Now, if you look at what that market does, and I'll cite that Bowhurst research again, they looked at 500 or 600 companies, and over 5 or 6 or 7 years, that delivered 34% year on year. So that's what that market is doing. If you look around the kind of maths around portfolio construction theory, in order to tend towards that market rate of return, you've got to have a portfolio size of at least 100 companies, and ideally it needs to tend towards 500. So we'll publish links to a lot of the work that's been done around that. So we're here to tell, I guess, investors and their advisors about, you know, what makes us different as a fund manager. The reality is, as long as we pass certain quality bars, like we don't charge rapacious fees and we don't back things that are just wildly stupid, then we probably change the dial on your investment returns maybe by like 2 or 3 or 4 or 5%. That's the impact we're going to have as a fund manager. The biggest impact that you're going to have is by building this very diverse portfolio. And I think what's great is that we've got a number of very diverse fund managers in the industry, and on this call today and on other calls that have been on. And what we need to do as an industry is make it easier for the advisor to go, oh, I've got £100,000 worth of SEIS I want to deploy. Those guys will do 7, they'll do 10, they'll do 15, and just split the money up so that within one application process, you can get your client's money into 50 companies 1 year, and the next year into another 50, and the next year into another 50. And if we take that approach as an industry, yeah, we'll have winners and losers amongst fund managers, but broadly, the investor will always, certainly with the tax wrappers available, will always get a very, very healthy return on investment. And that's what diversification in portfolio means for me. It's not really what Nova does. It's not what anyone else does. It's about how do we make it easy for the advisor to build a very large portfolio for the investor.
Yeah, or the investor directly, because with our platform, that a little helpful plug. Is you can fill out one digital application on our platform and now invest across multiple different funds. So it's technology, whether you're using us or anybody else, technology can help drive a larger diversification, and it can be easier managed. Up until even 2 years ago, what you're talking about, Andy, would have been a paperwork nightmare. But actually now it can all be managed on our platform or digitally anyway. So thank you for that. Just before wrapping up, just time for Keelan and Matthew. Just wondered what your thoughts are. Keelan, I just wondered what diversification means for you.
I suppose it differs between EIS and SEIS. We give probably 10 to 12 companies on EIS, but more like 4 to 5 in SEIS. And I think diversification for an investor in SEIS, who's perhaps a wealth manager who's using this product, probably wants to diversify amongst a few managers. I know there's you mentioned about asset allocation. There used to be, famously, Peter Lynch from the Magellan Fund, Fidelity's flagship, used to be ridiculed because he was over diversified. And then I suppose you have another extreme like Terry Fund Smith, who tends to concentrate on a few companies. And I think we'd probably be closer if you just came into Simvan's fund in the Terry Smith, looking for a few selected opportunities. And that's really to do with our investment approach. We again, hence coming back to why you probably want to use more than one fund manager in SEIS. We feel comfortable with picking a few each year because we do spend a lot of time. We've spent as much time as a year and a half, should I say, on one of our SEIS investments. Now that's subsequently gone on to be quite a successful EIS investment. And a lot of that, to be fair, was working with the company before we invested and moving them from a B2C to a B2B proposition. And they since have pivoted within the subsector that they're targeting. So yeah, if you invest in Simvan's SEIS, you get typically about 4 or 5 companies.
Okay, all right, thank you, Keelan. And Matthew, diversification. What does it mean? What does it mean to you, and what does it mean at Worth Capital?
I'll just take very brief time just to tease apart 2 things, because I think in your answers you've heard about 2 different things. I think Damon and Jeffrey talked about diversity and inclusion, and Andy and Keelan were talking about diversification in a more traditional sense. On the first one, diversity and inclusion, I think that's interesting for advisors and investors to ask their fund manager, but purely as an indication of how well those fund managers are removing their innate bias. We all have innate bias. And those kind of figures on diversity and inclusion are an indicator of how well you are assessing the market and the idea and the team, rather than following your sort of like normal innate instincts. On the second part, diversification of portfolio, the more traditional thing that we talk about, yeah, I think I haven't really got much more to add other than, we're all sector agnostic. Advisors should be looking across a different range of funds. I slightly disagree with Andy. I think that the choice of manager and the help that they provide and the choices that they make is going to, when you look at the maths, is going to deliver more than a single-digit percentage difference. But the fundamental principle is about a wide number of opportunities, and then you just need to do the maths, and that's what makes SEIS great. Is alongside the tax reliefs, and the valuations and the multiples, if you do the maths right, you're going to get a good return.
Okay, thank you. Well, that's timely. We're sort of just about out of time. So all of these funds are available on our platform, and if you'd like any questions, then please contact the team at CoInvestor, or indeed any of the fund managers directly. Tomorrow we'll be talking about the wonderful world of EIS. I know we've touched upon it a little bit today, so please everybody join us for that. But for now, I'd like to thank Keelan, Matthew, Andy, Jeffrey, and Damon for your time and for your thoughts, and on a fairly diversified conversation. So thank you all for your time, and thank you everyone who's attended.
Thank you.